Hi, it's Dominic Picarda and Tony Laporta here for NakedTrader.com. Tony, welcome to London, or should I say welcome back to London, because you were based here for a long time,
Yes, I was. I lived here from 1982 to 1988 and 91 to 97 trading on the Life Exchange. So I'm back. I watched a little bit of football last night, Chelsea-Man U. Chelsea lost 2-1. And I am here this morning with Dominic Picarda at the offices of the Financial Times. Dominic is a writer for the Weekend FT and Investor Chronicle. So
I read Tony's stuff, Tony reads my stuff. So.
Yeah. And we've been reading each other's stuff for a couple of years now, and it's one analyst to another sort of thing. So we're just going to do a little one-on-one here, maybe talk some markets, talk a little bit about QE2, and I'll let Dominic take it away. So.
Well, you've been in the game a lot longer than I. You've been in the markets for 30 years, maybe a bit more. Have you ever seen conditions like these?
Well, I mean, I base everything on this rally that we've seen, this 2-year rally that we've seen on Wall Street, and there's been no. What's driving me crazy and driving people with the years under my belt, like myself, is the manipulation involved, the money that's being spent to drive the stock market higher to get people to spend. And what I'm seeing in London and what I've heard the last couple of days is, I mean, the city is vibrant, but there's a lot of foreign money coming into the city. What I'm seeing in America is people are depressed. People are putting petrol in their tank at $4 a gallon, and they're not pleased about it. So I'm seeing two different lights, and it was actually, for me, it was very good to get to London this morning or this week, because the city is vibrant, and I'm not seeing that in America. I'm not getting that same sort of feel in America.
It's vibrant, it's based on manipulation, it's based on printed money. We know which way the game is rigged, so we know which way to play the game.
And that's one of the, I met with 20 to 25 dear mates yesterday, people I'd met in 1982 when I came to work here, and the big talk amongst all these very, very experienced traders was, okay, Counter Trend Tuesday, Wall Street's come off a little bit, we're going to buy it, and they all wanted to buy Wall Street at the end of the day yesterday, and I myself, actually, I bought a few S&Ps, a few Dow futures, and I'm realizing a small profit this morning, which is quite nice. So, everyone's talking about, as long as they're going to keep on throwing money at the stock market, you can't get in the way of it.
And this is the one thing that readers keep on asking me at the moment: what are we going to do when QE2 ends?
And as we discussed earlier today, okay, is it going to end? Is it really going to end? The stock market is supposed to be an indicator 6 to 9 months in the future. The stock market is telling us it's not going to end. That we are going to see more after June. And
sure, I believe that we're going to get QE2, maybe QE4, QE5, but let's focus on QE3. And what I'm worried about is the interim between QE2 and QE3. We saw last summer what happens when the taps go off, even just for a few months. The Fed is going to turn off the taps, see if this market can stand up on its own. In the meantime, you could get some very scary falls indeed, and that's what I'm kind of worrying about at the moment.
The market is being manipulated higher at the moment, and I traded in the pits. I'm a local at heart. I want to sell it so bad, and if they take the sugar bowl away, I do believe we're going to come off. I mean, the bears have been sitting waiting to attack this market, and they've been sitting patiently for 2 years. This has been a low volume rally.
I couldn't agree with you more. I think there are just loads of guys out there, particularly in the hedge funds. They've got big piles of money, and they're just itching to go short of this market. They need an excuse to do it, and the end of QE2 could be, we could see a bloodbath, a feeding frenzy,
I don't disagree. And I just don't feel the market should be up here, but I'm getting a whole different sense seeing the money being poured into London at the moment. I love a bear market, and I still think that what the Fed is doing to the markets. Eventually there's going to be a point where the rest of the world is going to say, we are not going to loan you money at 3.5%, 4.5%, and long-term rates are going to have to go up. And if when we see, and I do believe we will see the 10-year rate cross 4% someday, when that rate crosses 4%, then I do believe you'll be able to start thinking, okay, now it's time to really get on a long-term short in the stock market. Stock market's supposedly a 6 to 9 month indicator, so that time might be coming now. I'm getting a little bit bearish here at the moment, and technically bearish, had filled some gaps, but then I bought the market last night. So
this is one of the problems. QE2 has been such a game changer that a lot of the technical rules that you and I have been brought up on don't work anymore. I mean, there's never been a bull market in the history of the US going back to 1900 where volumes have shrunk progressively throughout. Now, normally you and I would see a market which is going up on volumes which are going down and down and down, and we'd want to get the hell out of that. Right. But this time, if you'd used that rule of thumb over the last 2 years, you'd have gotten killed.
What I know, Joe Public has missed this whole rally, and we're still almost waiting for that capitulation to the upside, almost, where they're in the bond market and they've done quite well being in the bond market. But one of these days, I still feel this bond market will fall out of bed. We'll see the money come out of bonds into the stock market, and that will probably be the high. But is there any confidence left in the stock market? I still feel the small man on the street in America, he doesn't want to know. They got burnt so bad in 2008, 2009 that they don't want to be in the stock market anymore. And the stock market is going back to being a game for the big boys.
Well, the guy on the street always gets in at the wrong moment. In 1999, he got into tech. In 2006, 2007 here in London, the big thing was property funds. Maybe when we were up around 20 times price to earnings on the S&P, he's going to start getting back in there, and he's going to get burnt for a third time. Or maybe he's not, because he's gotten so badly burnt the first 2 times.
What I have with a lot of my dear friends, and I'm a baby boomer, and a lot of them have, they've done quite well. Some of them, haven't saved their money like they should, but they're at the point in their life where they're into capital preservation. They almost don't. They don't want to be in the market anymore. They got burnt so bad, and the market's come back. I have a dear friend whose father worked for Caterpillar, and his mom is still alive, 93 years old, thousands and thousands of shares of cat stock, and he knows that his mom will pass away someday, and he will inherit quite a few million in stock. He does not want to be in the stock market. His mom's in the stock market with his sort of, that's his fund, shall we say, and he does not want his capital in the stock market. And I don't think he's the only American like that.
But the bond market, I think, if we do go down to QE2, QE3, QE4, eventually the bond market is going to go up in smoke. I mean, that's a big problem for the older community, for pensioners, for living on fixed incomes. Right. I mean, this is going to be a bloodbath. It sounds like a benign solution, or we're just going to obliterate the debt, but actually one man's debt is another man's retirement fund. We're going to have a generation of impoverished pensioners if we keep going like this.
Well, and you're going to have a U.S. dollar. If Bernanke keeps at what he's up to, the dollar will plummet. And it's going to cost Americans. I mean, it's going to cost, the price of commodities, the price of energy. I mean, you're looking at what, $105 a barrel crude at the moment. I mean, it's just not. I just don't believe it. I don't believe any of it. I think Bernanke's playing with fire, and I really fear for the future. So,
of course, it's not just the US that's playing these games with money, and now with all the terrible events we've seen in Japan, the Japanese central bank's going to go down another route of QE themselves, and that's going to create yet more liquidity. This is another support for the market, isn't it? We're going to have carry trade in yen again.
That was one of the things my mate Rick Santelli said after the tsunami was, well, guess what? QE3 is back on the table. So does it come out of America? Does it come out of Japan? it's going to come. They have, they're printing money, and the money has to go somewhere. And it's been going into the stock market, and I believe it's going to continue. But I want to be short. Up here, I want to be short.
So we both agree there's going to be lots more QE with lots of numbers after it. How does that affect the forecast or the prediction you made about a year ago that one day we were going to see the Dow again falling to 2,000? I mean,
see, I've been in the market since 1979 is when I got involved, and I lived through the crash of '87, and what we saw over that 3-4 day period, 5 day period, was capitulation. And there's many in the markets that say what we saw in 2008, 2009 was capitulation. For me, capitulation is what I saw in 1987. 1987, on October 19th, October 20th, that's when the phrase "flight to quality" was coined. When on October 19th, they sold their stocks and bought bonds, and that's the day flight to quality was coined. That for me was capitulation. I still don't think we've seen it yet. I still think, and it may not come for a couple of years, but I do believe that we will go back down. They have to take the sugar bowl away eventually, and we will go back down and test those lows. What was it, 666 or whatever?
666.
And
fundamentally speaking,
or we're going to do a Zimbabwe job and we're going to 25,000.
So if you can buy the stock market but short the US dollar, then you make a killing.
Right, absolutely.
Right. Okay.
Absolutely.
But fundamentally speaking, you're absolutely right as well, because there's never been a long-term bear market, and that's what we're in now, where where stocks bottom out on a PE of 13, and that was the lowest we got to, I think, back in March of 2009.
Right.
All previous bear markets in history, the really savage ones, the kind of one that we're in now, they've all ended with PEs in single digits, maybe about 7, 8, 9.
Right.
We're not even anywhere near that yet.
No, and it goes what I saw in 1987. I've been looking for it again, and I do believe it'll happen. I don't, until the U.S. get the housing market going, it's not going to give the consumer any confidence. And I've been watching homes, the same home on the market for 3-4 years. They take it off in the winter, they put it back on in the spring. Homes are not selling. People are more worried about their job. They say the definition of a recession is when I can't remember. Your neighbor depression is when your neighbor loses your job. Depression is when you lose your job. Do you know what I mean?
And Ronald Reagan completed that. He said, and the recovery is when Jimmy Carter loses his job.
Yeah.
Okay.
So, I don't know. I don't know how much higher the Dow can go. We can, I'm long it right now.
Yeah, but come on, let's face facts. If I told you 2 years ago that we'd be sitting on a situation where the Dow had rallied to 12,000, you'd have laughed at me. Sold. I mean, and I'm not the only one that was looking at the fall of 2009 thinking, okay, this bounce is enough. Dow 8,000, 8,500, 8,800. And I was bearish for a long time and wrong. And same here. But the problem is now taking that thing. I'm in sympathy with you, what you're saying here. But the fact is, from a technical point of view, from the longer term technicals, we haven't got any of the signs that you normally get near a major top with breadth, with momentum, even the age of the bear market, or age of the bull market rather. All of these things still say, well, we could go a little bit higher. I'm talking
absolutely.
maybe even revisiting the highs.
Sure. Why not? I mean, Japan's been in a bear market for 20 some years,
yeah.
but there have been huge corrections within the bear. But just a couple of years ago, they traded to new lows for the move. What did Japan trade up to, like the Nikkei, 35,000 or something like that?
39,000 in December of 1989, and I think it crashed down last year to 7,000.
Right,
6, 7,
which was the lowest of the move. But it came down, to 10, bounced up 17 or 18 a couple of times. They had big moves within the break, but it actually did trade to more new lows a couple of years ago.
Okay, so we know there's more printed money on the table. What do you think of precious metals?
Well, I started in the gold market at the Chicago Mercantile Exchange in 1979. And gold was $280 an ounce. And I watched it go to $850 and down to $500 as a clerk doing my thing. And back in '02, I saw, well, you had some technical formations and gold broke above a channel and around the $300 level. And for years I wrote about, did you hear that? Did someone say buy gold? Did you hear that? Did someone say buy gold? And I did get some readers long in the low 300s, and you know, they took $20, $30 out of it. It's like they hadn't seen a gold move like that in such a long time, you know. And now we're 1,500. If the Dow goes to where there's a technical formation in the dollar, if we can get on a couple monthly basis this dollar to close below the dollar index 7,400, it could go to 5,900. I mean, that's what, another 20% move lower in the dollar. If that's going there, then we may see capitulation to the upside in the gold market.
My problem with gold at the moment is it just never seems to play the safe haven role that people think. When people are worried about inflation, sure, it goes up. But particularly yesterday when we had more scares out of about Japan, whatever, actually gold seems to fall in sympathy with the stock market. And this comes back to what Bob Proctor's been talking about, where it's all the same market. Cash is just flowing into anything with a pulse.
Yeah, that's right. That's right. It's all, the cash is running after any asset, and I believe the stock market is just like another commodity.
Yeah, and my problem is if the taps get turned off, albeit only temporarily, then we could get this massive fallout. In the gold price, it'll be a great buying opportunity, but there are a lot of people who are going to get long and who are going to be long and they're going to get burned. And
a lot of people, I mean, you know, look at the price of silver. What, $41 an ounce now? I mean, you know,
that's beginning to look more and more like a bubble. I mean, that is just going straight up, perpendicular. I'm bullish on silver, but I just think the move is going too far too fast. And we're now at a level that we could easily see another 30% pullback, just like the last four occasions.
And so what does that take it back down to? $29, $30? I mean, that's still, you know, silver historically is traded around $4 or $5. You know, and now it's $40. I don't know. I own some silver. You know, I bought it many, many years ago, and I just put it away in actually have
physical silver.
Physical silver.
Right.
And I put it away, and I don't have a lot of it. I mean, I don't have a lot of it at all. But it's worth 5 times what I paid for it. And, well, probably more than that, almost 10 times what I paid for it now.
Okay, what about your other long-term holdings? Because obviously you're a trading guy, short-term positions.
But my long-term holding, I have a 2002 PT Cruiser.
Oh, right, this is a car or both?
Yeah, this is my car. Okay. It's the best car on the street. No car payment for 5 years.
Getting personal, what have you got in your 401k?
What's that? Not a lot. Not a lot. I see
no
reason.
What holdings do
cash.
You don't stop?
Cash.
Right.
I see no reason at all to have anything else but cash. Even though I've been in cash for a while, so I've missed a lot of this move.
Right.
But what is so
it's
bad?
Capital preservation.
What is so bad about having cash? What is so bad?
Well, as long as it's on a variable rate. So that if you get inflation, then hopefully the rate you're getting is in. And then if you get deflation, you're also going to be protected.
I mean, 2 years ago, people were paying interest just so they could be in cash.
Right.
You know, I mean, they were, you know, interest rates were a negative 0.1%. You know, so they could be in cash. What is so bad about being in cash?
But is there any asset out there at the moment that you might own, or what would it take for you to get a big position in gold for the long term or something like that?
Well, you can't buy a $1,200 rally, can you? You know, and call it a long-term play. I mean, you know markets as well as I do. When they come off hard. They come off really hard. I mean, gold could be back. I don't know. The only thing I know is there's a lot of money out there chasing assets at the moment, and gold's another one. And I don't trust anything up here.
You like emerging markets?
What's that? I don't trust it. No, I don't trust anything up here. Nothing. But I trade day to day, you know. And like I said, I bought the Dow and the SPUs and the NASDAQ yesterday, and realizing a small profit today. But I want to be sure. I want to be short up here so bad I can taste it. So, and that's a long-term look at the markets, and I do think in 18 months it's not going to be pretty. But if they keep the printing presses open, then I'm wrong to be bearish up here.
Tony, thank you for coming in.
Dominic, it's been a pleasure. Thank you so much. This is Tony Laporta and Dominic Picarda for Naked Trader checking off. Cheers.